Right, so let's jump right in. Today we're going to be looking at some of these kind of head-scratching moves by Warren Buffett, the guy who invented buy and hold forever, right?
Right.
Has been selling off billions in stock and just hoarding cash.
Yeah.
Like we haven't really seen before.
It's odd.
What's going on?
Yeah.
Does he see something we don't?
It's certainly raising eyebrows on Wall Street and in the financial press.
Yeah.
We're not talking about just sort of like a little spring cleaning of the portfolio.
Right.
He has dumped a third of his Apple holdings.
Wow.
And a staggering $266 billion.
Billion?
In Bank of America stock.
Yeah, that's a lot of money.
That's billion with a B.
Yeah, and it's not like he's reinvesting it.
Right.
Berkshire Hathaway is sitting on roughly $325 billion in cash.
Yeah.
Which is more than half of its portfolio value.
Yeah.
So what is behind this massive shift?
Well, one of the loudest whispers that you're hearing in the financial world is that Buffett is sensing a seriously overvalued market.
Yeah.
And frankly, some of the numbers back that up.
Are you talking about the PE ratio? That price to earnings thing?
The price to earnings metric that everyone's always talking about.
Yeah.
The S&P 500 is currently rocking a PE ratio.
Okay.
North of 30.
Wow.
That's almost double its historical average.
And so that means that things are more expensive than they should be?
Well, yeah. I mean, historically, when you see a high PE ratio, it tends to precede market dips.
Interesting.
So it paints a pretty interesting picture.
Okay, and then there's the Buffett indicator.
Right.
I know he really likes that one.
He swears by this.
Yeah.
To gauge the overall market health.
Yeah.
What it does is it compares the total value of the U.S. stock market to the country's GDP.
Okay.
Anything above 100% is considered to be overvalued.
Oh.
Well, brace yourself.
Okay.
Because the current reading is a whopping 211%.
Oh, my gosh.
Yeah.
That's so high.
Yeah. To give you some context, it was around 105% just before the 2008 financial crisis hit.
That's really scary.
Yeah.
So is he basically just taking his chips off the table
Dude,
before things go south?
It's a plausible explanation.
Yeah.
But, you also have to look at some of the other factors that are at play here.
Right.
Like interest rates.
Yeah, the Fed's been on a hiking spree.
Right.
Trying to, tackle inflation.
Absolutely.
But that also makes it harder for companies to borrow money.
Exactly.
Which could slow down the economy.
Right. And what's interesting is historically when the Fed cuts interest rates, it's often after. The economy has already started showing signs of weakness.
Oh, so they're
It's almost like they're admitting
reacting.
they're trying to play catch up.
Oh.
Yeah.
Interesting. Okay.
So maybe Buffett's thinking, if the Fed is already pulling these levers, is a recession looming?
Yeah.
Should I batten down the hatches?
Right.
Now, some folks initially thought maybe he was making a tax play, selling off stock when capital gains taxes were lower under the previous administration. But that kind of went out the window when those same tax policies were extended.
Right, because if he was doing that, he would have just bought the stock back.
Exactly.
Yeah.
If taxes were the main driver, we would likely see him buying back those shares.
Right.
The fact that he hasn't really lends credence to this idea that he's seeing trouble on the horizon,
Okay.
with market overvaluation being a major red flag.
So we've got a potentially inflated market.
Right.
Rising interest rates that are kind of spooking investors. Anything else?
Well, you've got to consider what people have been calling the Magnificent Seven.
Okay.
These tech giants that have been practically carrying the market on their shoulders.
It's like NVIDIA and Alphabet and Amazon.
Precisely.
All those guys.
Well, while they're undoubtedly innovative companies,
Sure.
when such a small group drives most of the market growth, it can create a distorted picture of the overall market health.
Right, almost like a bubble.
Yeah.
Where those stocks are getting inflated beyond their value.
Yeah, it's the concern. And this type of concentrated growth tends to make Buffett a hardcore value investor.
Right.
Really nervous.
Okay.
He's all about solid fundamentals.
Yeah.
And proven track records, not just hype.
So market overvaluation, rising interest rates, they could signal a recession.
Mm-hmm.
And this Magnificent Seven phenomenon.
Yeah.
No wonder he's skittish.
It's certainly enough to give anyone pause.
Yeah.
But before you start panicking about your own portfolio.
Well, let's maybe take a breath and come back in part 2 to unpack what all of this means for the average investor.
Sounds good.
All right, we'll be right back. Okay, so we've laid out some pretty compelling reasons why Buffett might be hitting the pause button. But what does this mean for like you and me and our investments?
Well, it's important to remember we're not giving financial advice here.
Right.
What we're doing is just encouraging you to think critically and strategically about your own financial goals and your risk tolerance.
We're not saying copy Buffett's every move.
No.
But it can be helpful to understand his logic. So where do we even begin?
I think a good starting point is recognizing that there's no one-size-fits-all answer here. You know, some investors might feel the need to really batten down the hatches, shift assets from stocks to bonds, which are generally considered less volatile.
Bonds being the safe haven.
Right.
But they don't really make as much as stocks.
Exactly. It's about finding that balance between risk and potential reward. That aligns with your own personal comfort level.
Right.
Other investors might decide to stay the course, believing that any market correction will be temporary and long-term growth will prevail.
Like riding out the storm.
Essentially.
Yeah. But what if it's a hurricane?
Well, that's where diversification comes in,
Right.
Spreading your investments across different asset classes, sectors, geographical regions.
Don't put all your eggs in one basket.
Exactly.
Right. Especially with this bubble talk.
Absolutely.
Yeah.
Another crucial factor is your time horizon. If you're investing for the long haul, say for decades down the road, short-term market swings might not be as worrisome.
Because over time, things...
Yeah, the market tends to correct itself, and you have more opportunity to recover from any dips.
Right, okay.
But if you have shorter-term goals, like buying a house or a car in the next few years, you might want to consider a more cautious approach.
So it kind of sounds like there's no magic formula.
No magic bullet.
It's just knowing yourself.
Yeah, it really boils down to understanding your own financial needs, your goals, your risk appetite, do your research, weigh the risks, and make informed decisions that align with your own personal financial situation.
And I guess if you need help, talk to a financial advisor.
There you go. There are resources available if you need guidance.
Yeah. Okay, so no crystal ball, but we can at least make smart decisions.
Yeah.
But I got to admit, sometimes it feels like trying to predict the weather.
That's a great analogy. You can check the forecast and make educated guesses. But ultimately, you never know for sure if you're going to end up basking in sunshine.
Right.
Or caught in a downpour.
Exactly. But hey, that's part of the thrill, right?
It certainly keeps things interesting. The key takeaway here is to be aware of the potential risks, understand how to manage them. Yeah. Even though we can't know for sure what the future holds, learning from seasoned investors like Buffett, who's clearly in a cautious mode, can be incredibly insightful.
So no need to panic, but definitely time to reevaluate.
Be informed.
Yeah. Our game plan.
Be proactive about managing your investments.
Speaking of Buffett's moves, there's actually one more fascinating piece of the puzzle we haven't touched on yet.
Oh.
Something that might surprise you. All right, so we've talked market overvaluation, interest rates, the whole Magnificent Seven thing.
Right.
But there's one more Warren Buffett curveball that I don't get.
Oh, really?
Okay, so despite his legendary status as this hardcore value investor and his clear concerns about market risk right now, Warren Buffett has never touched crypto.
Yeah, that's right.
Really?
He is completely steered clear of Bitcoin and the entire crypto craze.
That's wild to me, with all this hype and everything, he's just nope.
Yeah, he's been incredibly vocal about his skepticism.
Has he really?
Oh, yeah, even calling Bitcoin rat poison squared at one point.
Okay, so is he missing the boat here?
Well.
Or, is there actually something to this?
I mean, it's a debate that's been raging for years now.
Yeah.
On the one hand, you've got crypto that's shown insane volatility.
Right.
It's been plagued by scams and regulatory crackdowns.
Yeah, I mean, all those stories about people losing their life savings.
Exactly.
That makes me nervous.
But on the other hand, you've got blockchain technology, which is the foundation of these cryptocurrencies. And it does have the potential to disrupt a lot of industries. Finance, supply chains.
So is he just being overly cautious?
Yeah. Is he missing out on this gold mine? Yeah. Or is he wisely avoiding this speculative bubble?
Right.
I mean, it's a fascinating question that really gets to the heart of how we approach innovation and disruption in investing.
Okay.
Buffett built his fortune on these established, profitable companies, the blue chips.
Coca-Cola.
Coca-Cola is the American Express of the world.
Steady performers.
Yeah. But in a world where technology is constantly changing the game,
right,
is that playbook still relevant?
Could it leave you behind?
Yeah. So Is Buffett's crypto aversion a sign that he's out of touch?
Right.
Or is he staying true to his principles and just avoiding what he sees as this unpredictable gamble?
It's so hard to say.
Yeah.
I guess only time will tell.
Right.
Yeah.
Will crypto become this transformative force, or will it fade away?
Yeah, but it's definitely an interesting example
Absolutely.
of these challenges in
Yeah.
investing.
And it reminds us that even the greatest investors, like Warren Buffett,
Don't have all the answers.
right, they make calculated bets based on their experience.
Their worldview.
Yeah, and sometimes those bets don't pay off.
Well, that's definitely food for thought.
Sure is.
So as we wrap up this deep dive into Warren Buffett's recent moves,
Mm-hmm.
the big question is this.
Yeah.
If even the Oracle of Omaha is feeling this cautious,
Mm-hmm.
what adjustments should you consider making?
To your own portfolio
Yeah.
with all these potential risks out there.
It's something to think about.
It is.
Knowledge is power.
Absolutely.
Stay informed, be proactive, and you'll be able to navigate these uncertain waters.
With a lot more confidence.
Couldn't agree more. So keep those thinking caps on, fellow deep divers, and until next time, happy investing.